And thank you everyone for coming today. My name is Jason O'Halloran and I'm one of the client service partners at SLC Partners. And I'm here today with Priya Rusogi, who is also one of my partners. And her and Paul Coyle, who's not on the presentation today, are the cross-border tax partners of the firm. And I'm excited to talk to you about U.S. estate taxes and options you can do to avoid them.
Hello, everyone. Thank you for your time today. We'll talk about U.S. estate taxes, and what I would start saying is we all have U.S. estate tax exposure. Often we get questions, do I owe or do I have exposure for U.S. estate tax? I would say the question should be, how much is the exposure? And I'm very confident today that whoever is attending the seminar today has U.S. exposure. Because at least if you are investing in your portfolios or retirement plans in US securities, you are caught. You have a direct exposure there. So the question is, how much exposure, how big is the value of that exposure I have? And you might have also come across a situation.
Sorry, we're trying to put the slide on for you.
Sorry. So we will also discuss in this presentation, what are the obvious and non-obvious options for US estate taxes, mechanics, how US estate tax works, and some planning strategies for you to minimize or to reduce your overall US estate exposure. So let's start with the slide. The first is, what is US estate tax? And what is estate tax? Estate tax is basically a tax on your worldwide estate at the time of death. For US citizens, US imposes tax on the worldwide estate, irrelevant or where this property or where the estate is situated. But for Canadians, US estate tax applies only to a US situs assets for the deceased. US situs assets means the assets which are in the US. So for 2024, the US tax payable, there would be US estate tax payable if your worldwide estate is more than 13.61 million US dollars. Keeping in mind that effective from January of 2026, this worldwide estate exemption of 13.1 million gets down to 6 million, subject to some exemptions. So certainly we would have to do some planning in next year or so that your exposure to US estate tax is minimal. Also, in order to claim this 13.61 million exemption, you are required to file US tax return. Otherwise, this exemption will not be applicable to you. The highest marginal tax rate for US estate tax is 40%. And that gets very soon there. As soon as you hit $1 million in your worldwide estate, your marginal tax rate hits 40%. We'll show the tax brackets after a couple of slides, but to give a heads up that the marginal tax rate is 40% on estate tax, and that hits as soon as you hit $1 million USD. So how does US estate tax really help Canadians, or how it impacts Canadians? So as a Canadian resident, you may be subject to US tax when your US situs asset, which is basically your US assets, which I'll define in definition in next slides. But if your US assets are more than $60,000, and when the value of your worldwide asset or worldwide estate is above the lifetime exemption, and the lifetime exemption which we are talking about is $13.61 million. So in case you have US situs assets for more than $60,000 and your worldwide asset or estate is more than $13.61 million in US, you will be required to pay some US taxes, US estate taxes, because your asset is more than the threshold. And as per Canada-US tax treaty, this exemption of the taxes this exemption limit can be used to reduce your overall estate taxes. So to just make it simple, I would say if someone passes away in 2024, and if their gross estate value is less than 13.61 million. What does that mean is you would certainly not owe US estate taxes, but you will be required to file US estate return to claim this exemption. If you don't file this return to claim the exemption, then then exemption would be denied and you would have to pay tax 40% at a marginal rate on your estate, on your US estate. So just keep in mind, whether you are claiming an exemption or whether you owe taxes based on your worldwide estate, you are required to file a US return to claim the treaty position and to pay the additional tax if required.
So just for clarity there, anything above 60,000 US would suddenly be a problem. And so you'd want to file.
That is correct. And that 60,000 is very simple to get if you are investing in US portfolio through your registered accounts and all. So we'll get to another slides. Let's talk about the mechanics of how US estate works. So the way it works is we need to think about what US estates are, how US assets are, how it is related to worldwide estate, and how the calculation of the credit works. So as the name itself defines, US assets, very explanatory, whatever you have in the US is considered as US assets, which means US real estate, household goods which you have in the US estates, US pension plans, debts issued to US person or entities. But the very obvious or non-obvious that has been missed is US stocks that's been held in your registered accounts, in your non-registered accounts. Registered accounts means TFSA, RRSP, your REFS account, or non-registered accounts are your Canadian brokerage account. So we are talking about US securities, example, securities of Apple, shares of Apple's, Tesla, IBM. So these are all US issued shares. Means the company or the corporation that was incorporated in the US. So that is important to keep in mind, not that you held it in your Canadian account, but it's the issuance authority is where it is driven. So all the US issued stocks becomes a part of your US citus asset. And in my RRSP, I'm sure in most of you, that RSP, it is very difficult to get away investing in US market. So I'm very confident that most of us have US securities in their either registered account or in their non-registered account.
Can I maybe just stop there for a second, Priya, just to reiterate, like Priya's explained all of the issues quite well on it, but like if you just put it in sort of layman's terms on what the issues are, like it's easy, like in an environment in Canada where everything seems to be tied to the US in some degree, it's easy to inadvertently have more than 60,000 US worth of assets, even if you don't, like you look at the schedule, I look at this and I think, is this relevant to everybody? I think certainly if you have a high net worth, like you got to do a lot of planning, but even if it's not that high, just by having some savings for retirement, you could inadvertently have a tax problem. Most people know about real estate in the US would be something that they need to be worried about in their planning, because like you can't move it out of the country, right? It's in the US. But the other stuff that isn't obvious is the stocks. Loans to US persons could be a problem. There could also be, there's lots of Americans living in Canada, and the loans to US persons would also be subject to US estate tax. So I'm not sure that's as widespread, but some of the business owner situations, they're like, you need to kind of look at it. There are, like the easiest solution is if you're exempt, we just file a return and you're okay, or your estate files it, but there are other things depending on what the nature of your, the assets and the risks you're trying to avoid, we would have different scenarios. So we're going to go into some of the planning. It's meant to be general in nature. Because if there's anything specific, obviously we customize a plan, and our focus is always first trying to make things simple. And then if we need to make it more complicated, we would explain why it's important that you need to do something a little bit more elaborate. But that's the key. The mechanics also is important, and Priya's going to talk about those too.
Mhm.
If you'd like to, if there's any questions in the chat that you think before we should move forward on it, I'm happy to answer anything, or Priya is. We should check. I guess, Stephanie, we're good?
Yeah, we're good right now. Yes, for sure.
Okay, good. Okay, so we'll move on. Must be clear as a bell.
So the second mechanics of evaluating US estate is the worldwide estate you have. So as obvious, what we are trying to do is Iris wants to look at what is your worldwide estate and what percent of your worldwide estate is a US Titus asset. So worldwide estate, as the name suggests, it is all what you had at the time of your death, all the property that got transferred to the beneficiaries, the properties that you had through joint ownership, then your RSPs, RIPs, TFSAs. In that case, everything should be a part of your calculation of worldwide estate for US purposes. The one thing that's always missed, or that should be actually given more attention, is life insurance. So what happens is in calculating the worldwide estate, if the deceased had a life insurance policy, and if the deceased was the owner of the policy, that becomes a part of your worldwide estate, which is contrary to Canada. Right, so in that case, we have to keep in mind when we calculate the US worldwide estate for US purposes, we need to remember that if their deceased had a life insurance policy, if yes, that should be added. And the second topic, which I'll point out under worldwide estate, is your principal residence. So if it's a joint home, you need to also include your principal residence in calculating the worldwide estate. So when you calculate the worldwide estate, you include US Titus assets, all obvious estate parts which you think, but keep in mind your principal resident and insurance, life insurance, because that kind of adds up. And trust me, when you add all these, it is very easy to get to $13.61 million USD, because the shares which you are holding in your corporation is also part of your worldwide estate. So that 13 million is very easy to reach. So we need to make sure we do the calculation appropriately to see how close are we to the 13.61 million benchmark, and if any planning is required there.
Okay, just before you move on, Priya, like so there's the 13 is one thing, but it's also like, I think the key is also known if file. But the second part, and the mechanics are again important when we go through this. But the other thing that the joint property that I don't know is intuitive to people, that can be double counted depending on whether you or not you can support proportional contribution. So if you have something that's joint, it might count 100% for each person that dies. And so you kind of inadvertently could have bad math because of how title is held on certain things. And that could make it a little more applicable to you, the calculation, than it otherwise would be. And insurance, again, is another big one. Most people don't think of that as part of their estate, at least not Canadian tax accountants, because it doesn't count for purposes of their deemed disposition and things like that in Canada. But in the US, it does if they're the owner. It's added to their estate. So the math can be affected quite quickly. Again, if there's questions, Stephanie, we're looking to you to tell us if we need to stop or move forward.
Definitely. And if there's anybody that wants to unmute themselves to ask a question, you could do right now, or you can give some a minute right now. You're okay?
Mhm.
All right. I think we're looking good.
So this slide, I purposely put it there so that you kind of see how US estate tax rates work. So as I said in a few slides before, that as soon as you hit $1 million value of the asset, you hit 40%. So you pay the base tier tax based on what your net worth is, and then you pay tax on the additional as a margin tax. So it's a marginal tax. So say from 250,000 to half a million, we are looking at 34%. But before that, above 500,000, there's a base tax of 70,800. So it kind of do it very similar to the way it works in Canada. But the US tax rate, we always say the highest tax rate is 40%. It's the highest marginal tax rate. But then again, it kind of does the math, which grinds down to close to 39% or 37%. Now, we'll talk about the credit. We have been talking about the exemption, which is 13.61 million exemption. How does this exemption is linked to the credits? So US has a term called unified tax credit, which is unified credit is a combination of the estate and gift tax exemption in the US. Being a Canadian, we don't qualify for that gift tax exemption. So to start with, we will have 13.61 million exemption to start. So unified tax credit is a credit calculated on the $13.61 million of taxable estate to determine the tax available to reduce the tax liability in the year of death. So the credit calculated on, or the tax calculated on $13.561 million of asset is the credit which you would be able to claim. So as I said, if you look at the third bullet, it says unified tax credit of 5,389,800 USD effectively shelters $13.61 million of US estate. If we are, it is basically what happens is if we are not Canadians, we cannot use this exemption. So as per Canada-US tax treaty, Canadians are eligible to use this unified credit, and it can be applied to reduce their US tax on the US tax liability. So the way it works is the credit is prorated based on your US assets versus worldwide assets. There's an example there. We'll talk about that example shortly, but the dynamics, the way it works is that you will get a credit of % of your US CITES asset from $5.3 million of the taxes that is exempt, and that's free. So let's go with example that may make this math a little simpler for you. That Edward was a Canadian resident and a US non-resident. He's not a US citizen, no domicile in the US. He owned a home in Florida for about $2.1 million USD. Everything I'm talking here is in US dollars. So, and his worldwide estate at the time of the death was $14.05 million. Now we can clearly see that his estate is $440,000 more than the available exemption for tax year 2024. It is very obvious that the state would have to pay tax. Now we need to see how much of the tax would be allocated to Canadian for the US CITES asset. So using the appropriate tax tier, which I showed before, Edward would pay tax about $785,800 against his US home before any credit. So based on the math, if we were not entitled to the Canada-US tax treaty credit, Edward estate would have to pay $785,800 upon his death. But since we are Canadians, luckily, and we have a treaty with Canada in this regards, we would be able to use that exemption, which we talked before. So we see that US assets constitute about 15% of Edward's worldwide estate. As such, he's entitled to claim 15% of the unified tax credit on his return, on his estate tax return, which is 15% of closely of 5.3 million comes out to be $800,000 USD. Edwards, after using, now we know that the state would pay tax of $785,800. I'm able to claim an exemption up to $800,000. So what we see here is Edward estate will pay zero tax because his unified tax credit based on the math is sufficient or more than sufficient to eliminate his US estate tax. Again, keeping in mind that we can only use the unified tax credit if the returns are filed on a timely basis by the executor, and these returns are due 9 months after the date of death. IRS may have an option of getting these days extended, but if there's any payment that's due in different scenarios, then the payment and the extension is due within 9 months from the date of death. So one thing you may notice is I've been talking about $13.61 million of exemption, but Edward had $14.05 million of worldwide estate, and still his estate didn't do any tax. The catch is because of the marginal tax rate. It is not 40%, as we had talked before. So if in case his worldwide estate was 15 million, he would have owed some taxes in the US. So the 13.6 million is what they have said, but that 40% is not really 40%, little less than 40%. That's why even with an estate more than $13.6 million, Edward estate didn't pay any tax.
As long as he filed a return.
Yes.
Otherwise, he'd have to pay the tax there.
Correct. And then you would have to pay the tax. You would not be able to avail the treaty benefit. So you would have to pay, if you don't file the tax, you would owe $785,000, $800 in the States. And Canada will not give you the credit, because if you had done this, or if you had filed this on a timely basis, your tax liability in Canada would have been zero.
So let's just stop there before you go into the example where the law changes. Just like there is under the treaty, there is some offset against this tax is eligible for to offset against the deemed disposition tax. However, I could see that Canada would consider this a voluntary tax because you didn't file your tax return.
That is correct.
So you would be denied. So it's important.
It is, yeah. So I did mention that this 13.61 million exemption would be changed effective January of 2026, which would be close to $6 million subject to inflation. What happens when your exemption all of a sudden gets back to 6 million, from 13 million to 6 million? Then in that scenario, after applying the appropriate credit, because your estate tax would still be payable at $785,000, but now your credit got reduced because my exemption limit got reduced. So I can only use $350,000 of credit from the unified credit section. As such, his estate would owe $435,000 in the US, because his unified tax credit was not sufficient to cover the overall tax liability of $785,800. Knowing this, since this is coming very soon, again, I cannot re-emphasize, it is very important to keep in mind that 6 million is very easy to reach. So certainly we recommend a planning so that you can minimize your tax exposure in the future upon your death.
So just before you move on there, Priya, just for a little more clarity on it. The reason why it's going to 6 million in another year or so is because the original law, they increased the exemption, it basically expires.
Correct.
So it's going back to the lower threshold, unless there's a change in law, like you have to work with the lower exemption. So it depends on what you think is gonna happen with the political environment in the US, whether it'll go, like sometimes they pass a new law to change it, and then you're okay again, sometimes they don't. Like if I had a crystal ball to know exactly what would happen, then it would be easy. But so right now, I think you have to work with the lower exemption. The math also makes a big difference. So like it depends, the higher the ratio that you have of your assets in the US, then obviously you get a higher part of the credit. But both of the factors make a big factor into it. And also you need to, like, things like life insurance that are not obvious to put in it. And the example we have with Edward here has only the Florida home, but if you add some portfolio stocks, like suddenly then the math gets a little bit higher. And like we made this example very simple, we've just only shown one asset that's applicable. Everything would get thrown into the pot and then you do the math.
Right. So
And I'm just gonna ask if there's any questions up to this point from anyone. Again, please enter them into the chat, or you can unmute yourself.
Oh, hi. May I ask a quick question, please?
Of course, yes, please do.
Hi, phenomenal presentation. Thanks, guys. Question is, would you have an example where it's not just the real estate, but there is a portfolio of individual investments there. So that's the first question. And second, if you don't mind, is there an example where it's not personally held, the assets in US, it's in the corp? That's
Well, so one of the solutions when we're gonna talk about, like one of the ones I thought would be relevant to elaborate. Is like a lot of people, when we go down, first, like we'll go through the solutions in order of simplicity. But like a lot of people, what they try to do is that if they're elderly, like we have a lot of clients that move their US situs assets into a corporation that's in Canada. Because if they're not a US taxpayer, then you could essentially, the Canadian company owns it and it doesn't die. The person dies. So that's how you put it into an asset, you basically change the domicile by the individual shareholder moving it into a corporation. So in your example, you said with a corporation, like that would like it would be different. You look at, if it was in a US corporation, you have the same problem. So the domicile of where the company sits matters. As far as the, if portfolio instead of the house, like you could strike out the home in Florida and put US portfolio, the math works out the same. Does that answer your question? We'll talk about some, the Canadian corps and stuff in a moment.
Absolutely. Thanks a lot. Appreciate it.
Okay, good.
So now, in the next few slides, we'll talk about these structures, how we can plan, we can protect our Canadians from having the US estate tax exposure. The first three bullets I'm talking here is about individual ownership. That how the planning should be done in order to have individual ownership in real estate, or so that you are not paying double tax on it. Because firstly, in the individual ownership, as soon as you passing away, your property gets to your estate and you pay tax on it. We want to make sure in our planning to consider that the same asset is not taxed twice, one in one estate and one on passing of surviving beneficiary. And in the remaining four, where corporation comes in picture, is we say that corporations still exist, even the death of the deceased. So we want to make sure we put structure in place so that that doesn't become a part of the deceased estate. And there's a minimal compliance and minimum tax payable there.
So maybe just for a little more clarity on this, I think just to also tie in the last question about, we have a real estate example. It really is US situs assets ownership that we're talking about them all. It's just the Priya used Edward in the example, so we're following through with real estate. But I guess the first thing you have to do is you have to assess the need. So I think you have to look at your situation or whoever you're helping situation and look at, well, what happens if you do nothing? Okay, because the easiest thing to implement is doing nothing. So you look at the individual ownership and okay, well, this is what they've got. What happens if something happens to them? And so that's why I think you still start with the individual, because then you can look at it and see, well, like this is the default consequence. And even if you do owe some US taxes, if you can get a credit in Canada by filing the tax return and making sure that you're in compliance, like there's a number of things you need to do there. You might still leave it because it's easy. Individual ownership from a US point of view tends to have slightly better US tax treatment if it's something you have to pay US tax on. Real estate is one that you're forced to pay US tax on when you sell it. But if you're a Canadian owning US stocks, well, it's probably not taxable if you live in Canada. It's probably only subject to withholding tax type items on dividends and things like that. So it may not be as big of a deal, but you kind of need to walk through and do the calculations. So we start with simple and then we'll move into complexity. I will spend a little more time after Priya talks about the first ones on the Canadian Corp, just because it tied into the caller's question. And because I think that's one that's relevant to a lot of business owners.
So individual ownership, it's the simplest and low cost approach. So consideration should be kept, consideration should be given to ensure that there's an available exemption and credits are sufficient for us or for the individual to cover the US estate tax liability. In simple sense, that $6 million which we are talking about, that is the exemption on that 6 million good enough for me to use that credit to reduce my US estate tax to zero. So we need to keep that in mind when we are investing in US real estate or in the US and individually. It's a simple approach. It's a very low cost maintenance. Like if you owe taxes and if you pay taxes here in the States, you would get credit in Canada. So you're not paying double tax, first thing. And then also at the same time, it is very simple to go through. Again, a state tax return is required, even if there's no tax owing. And if you are married, then a proper planning is required in the will to prevent the same property to be taxed twice upon the death of the beneficiary or of the second person. Another thing to keep in mind is if you get non-recourse debt, that's ideal because that would reduce your US estate taxes and your worldwide estate. But knowing the trend, it's difficult to get it and it's worth looking at it though.
So maybe for a little more clarity on a couple of things. So on the point that Priya mentioned about the married, like what you want to avoid is that you have, that you don't kind of double up. So something happens to one spouse and they bequest it to the other spouse, and then suddenly it's back in the same math again. So you want to be careful on how you do that. So some planning, again, it depends on the person's net worth and the family's net worth. But sometimes you can just manage it through the will. It depends on the circumstances. The last item is the non-recourse debt is basically what you're trying to do there is you're trying to have debt that applies only to the US situs assets. So if you had $1 million there and a $500,000 loan that was only applicable to the real estate, those are the only times where I've really seen where the non-recourse debt has been applicable on these things. You could have your estate could be reduced by the debt. So it can't be kind of personally guaranteed. It's only offset with the US situs asset. It occurred to me maybe a margin is possible, but I've only seen it a few times where it's been workable because most of the time people don't like the cost of having the non-recourse debt, but it's worth looking at.
Now, second is joint tenancy with right of survivorship. So generally in Canada, like it is not recommended, if I would say, because if you are not able to prove the proportional ownership of the asset, then there's a risk of paying double tax on the same estate. So when you have joint tenancy with right of survivorship, the way it works is the deceased estate would pay 100% tax on it. And then when it gets to the second or to the survivors, the survivor would also pay, estate would also pay the tax upon his or her death on the same estate. So, because if you are able to clearly demonstrate the ownership that, or if you clearly prove that 50% of the capital or the money was put in by the other spouse or by another tenant, another person, it is okay. But sometimes it's very difficult to prove that there's a tracing there. And if there's a joint tenancy with no records of proportional ownership, it's very difficult for us of our US to defer US estate tax liability until the death of the first survivor.
So you basically get 100% each time unless you can prove otherwise. So if you do this road here, like it's tenants in common is the easier way to do it. If you're really going down that, there's other advantages. But you could, like, if you're gonna put joint tenancy, like I'd have, if something was bought in the US, I'd have them try to put each of them contribute half of the cost. So you can clearly demonstrate what somebody owns. Otherwise, I think you have risk that it's double counted.
Service phone, Luce.
Sorry?
Sorry, do we have any question?
I don't, we do have a question, but did someone unmute themselves? You can ask it live. No? Okay, we do have a question though. So the question is, this might not be related to the estate tax, but thought I'd ask in case. I have a small investment of roughly 150,000 in 401k investments held in the States as a result of employment contributions when I lived and worked there for 8 years. Should I be looking to convert my 401ks into a Canadian held RRSPs or other investment in Canada? Or should I leave it there and withdraw it from it when I retire? Will that affect my US estate tax liability either way?
Okay, go ahead.
So having the 401k in states certainly is a US status asset. And you have the US estate tax exposure there. Now, transferring your RRSP to Canadian, to your Canadian RRSP, it is doable. But then it's more cost involving because you would have to transfer your 401k funds to IRA, and then you would have to transfer from IRA to RRSP. And then also there's a subject of this transfer from IRA to the Canadian RRSP or to you would be subject to withholding. Depending upon what your goal is, you can think how it could be done. Jason?
So like, I guess in this situation there, so the first answer is, I think, yes, it is a US licensed asset. Well, the question is what to do. I think it's hard to do it in isolation. I would look at it, ultimately, estate tax applies when you die. So I don't like planning for everything just about somebody passing away. But I think you look in the context of what to do. Maybe it's something the person considers to spend quicker at some point versus some of their other assets, so they eliminate it that way. That situation, I think you look in its totality, and it also depends on whether or not, if you end up just having, if you're under the threshold at the time of when you pass away, I think what I would probably do is, it's not the end of the world to file the US tax return if the amount is zero, if you just do it properly. So I think you look at the things when you're doing, you just need to look at the full picture in order to determine what the best course of action. I don't think I would arbitrarily try to move things without kind of looking to see what the outcome is, because maybe it doesn't matter that much in your context. I would try to make it simpler instead of complicated unless it has to. There are a lot of situations where we end up having to make it complicated, but short, so I try to. Then hopefully that answers the question. We can take that offline afterwards, if they're interested.
Perfect, thank you.
Yes, that helped. Thank you very much.
Do we have any more questions?
We're good right now, unless someone else wants. Oh yeah, sorry, go ahead, Claude, go ahead.
Sorry, I just wanted to say thank you. That helps.
Okay, good.
Yeah.
All right, back to you both.
So the next structure, which for individuals we are in picture, is tenancy in common, where each spouse owns 50% of the real estate or the real property. So what happens is, when we have the ownership structure in form of tenancy in common, deceased pay taxes only on the reduced value of the real estate, because now he owned 50% of the real estate or 50% of the property. If I have to buy only 50%, there's a lack of marketability, and then I get minority discount as well. So in case if the structure is tenancy in common, the deceased pays estate taxes on the reduced value of the estate. And on passing, we need to do some planning that the passing it goes as per estate or per terms of the will. And sorry.
Yeah, no, it's okay. I wanted a clarity, I guess Priya's bringing up so 50, if it's tenants in common, 50%, whoever owns that. So let's just, Priya, I use you as an example.
Yeah.
So unfortunately you pass away, okay? And you have a property in the US, because I like the real estate theme for this part of it. And you pass away, and the 50% tenants in common goes to the terms of your will. And then it goes, whatever the will says, it ends up going to title according to those terms. If it's joint tenancy, it just goes automatically to your spouse, like your, whoever you have joint title. If I use your spouse as an example, okay? Your husband would get the full property, so there's no discount because he'll have full title to it. If it's tenants in common and it goes to the estate, okay, so then like who's gonna buy 50% of the property in Florida, for example, and then when they have, that your husband owns the other 50%. Like I can't
Right.
just go in and like, your husband's gonna be there, so like it's not worth the same, so there's a discount involved with having less than 50%. Because it's both less marketable and less, and because you own 50%, you can't control it. So that's puts in discounts, and those, they range depending on the nature of it, but it can reduce the value as well, just by having slightly different title. The downside with tenants in common is depending on where it is, you have to deal with probate. And so Florida is one where I worked with a client recently, and even though there's no tax owing, the probate is gonna cost a lot, and it's gonna take a while. So like you need to consider those things as well.
So we covered all the individual ones. Now we're getting to the corporate structure, which would be more effective for Canadian business owners. Is how about Canadian corporation? So generally, we don't recommend having the US real estate in Canadian corporation, because it could be anti-avoidance law that comes in picture for IRS and saying that you had planned this structure to avoid US estate taxes. But we have been using this corporation, Canadian corporation and blocker corporation in between to have the proper planning for US stocks, which could escape, which could help us to have no exposure from US estate taxes. And it's an excellent liability protection as well. But if in case, if you already have a property under Canadian corporation, then basically you have inability to own it personally. And if you use it, there's a taxable benefit there. With this structure also, there's a substantial high capital gains. Because, in Canada, capital gains are now pretty much getting to the peak. So this structure is not recommended for real estate, but certainly using a blocker corp can be used for US portfolios.
So let's maybe stop there a little bit, because I think this is important for people.
Right.
So like you have to weigh like the concerns, right? So if you think you're gonna pay 40% estate tax, that's a concern, like that's a value, not gains. So that's something that you need to weigh versus the income tax concerns, but certainly with Canada capital gains tax going up in the corporations, you don't get the 250,000 exemption, is less appealing. There's also not exactly the same integration of tax when you earn income in a corporation versus outside of it, slightly lower even before the change in law on capital gains. So these things are important to kind of weigh, because you wanna maximize your position, so you're paying the least amount of tax kind of either in Canada or the US. A lot of businesses, like the other issue they have is like from a business owner point of view, or expanding to the US, like there's another concern too, right? So you expand to the US, a lot of people, what they want to do is they want to try to isolate their risk when they go into a different market, so or even the risk, both business risk and tax risk. So they might have a US subsidiary if they're expanding. So they might have a US corporation. Well, that US corporation also is subject to US estate tax too, because it's a US corporation. So sometimes people have a Canadian company that's a blocker in there, that so that the Canadian or non-resident alien American doesn't own the US company directly. And so that this is a tool, certainly with people with a lot of US stocks that they don't want to sell. We have them owned by a Canadian corporation in order to try to shield them from the US estate tax, because otherwise they will pay it as Canadians.
So the next structure we'll talk about is Canadian limited partnership. So how about investing in US real estate through your Canadian partnership? What we are trying to do here is we are trying to move in the domicile of the real estate to Canada. Otherwise, what would happen is you would have to, that would become a part of US Citus asset. But having this structure, moving it to Canadian limited partnership, it would not be considered as US Citus asset.
Yeah, so for clarity on that too, it's not that the real estate is moving to Canada, the real estate authority is there.
Correct.
But you're trying to convert what you own
Domicile,
so that you own something that's Canadian and not US.
Correct. So what happens is in this scenario where you have limited partnership involved. So upon the death of the partners, an election has to be made with IRS for the estate protection. And it should be done within 75 days of the death of the partner. If that is not done, there is a risk of not being considered as a part, being considered as a part of estate. Then, if it's not done within 75 days, it can be part of the deceased estate. And another disadvantage of this structure is that it's a lot of compliance cost, because in Canada you'll have to file a partnership return. In the US, you'll still have to file the partnership return because it has a US Citus asset. And then the partners would have to file the US return as well, because they would get the slips to report the US income. So there's a lot of compliance cost involved, depending upon the volume, as Jason says, that we need to weigh in to see whether the structure makes sense or not. So that is one part to be kept in mind, and also any distribution from US partnership to the non-resident partners, which is Canadians, that's also subject to withholding. The advantage of having this limited partnership is that you kind of retain the control as compared to other structures, and it's easy for estate tax protection. The tax rates are pretty effective and lower compared to having this in the corporation. And the income is also taxed at your marginal rate in both the countries.
Yeah, and one point that I should maybe raise, that also from a US point of view, from a corporation, like at least the limited partnership that will have the same treatment in the US. And in the US, corporations don't get a special deal on capital gains. So it's just ordinary income, the same as every whatever other business income they have.
Correct. But
So consequently, it might matter to have something that's taxed on an individual level, might be better than having something taxed at the corporate level from an income tax point of view.
But knowing the corporate tax rate is 21%, and the max
Plus state.
plus state, which is if it's in Florida, we are looking at another 4.5%, compared to the individual tax, that's 20%, maximum 20% capital gains tax in the US. So next structure, we are talking about hybrid. How about the partnership is considered as partnership in Canada and being treated as corporation in the US? Why do we do that? It's an easier way. It is less time sensitive. It is lower tax rate in Canada, though the initial setup cost is high. So between the limited partnership and hybrid Canadian partnership, we need to weigh the advantage of having one structure over the other, because in Canada, it's a flow-through entity, which is all the income gets reported in your personal return. But in the US, it's taxed as a corporation. As such, the corporation will pay tax. Any distribution from the corporation to the partners is subject to withholding. So there's lots of this, like in simple terms, we can say this is one of the structure which we can consider, but we have to weigh in the advantage or benefit of it before making any decision between this or the partnership. Any comments, Susan?
No, I think it's good. I think if the numbers are the right work, then you look at it, because the outcome is good. It depends on how much it costs, and then that's all.
Right. So the next structure, which is very common in Canada especially, is a trust. It's very complex. We would just try to talk a little bit about it. And there are a lot of various type of trusts that can be considered when you are bringing US real estate in picture. And that we can cover briefly, but if it is applicable to you, if it kind of makes sense, we can certainly discuss offline. So having a trust in picture for US estate, US trust, or US real estate is good. Because it kind of helps you in protecting from estate tax. The assets are subject to lower capital gains tax rate, both in Canada and US, as compared to having the real estate incorporation. The disadvantage here is it's difficult when you already have the asset in your own name. There is a way around of moving this real estate in trust, paying the tax, we have to do some planning. But it does get tricky because there's a lot of moving parts to it. And in order to maintain the state tax protection, the trustees, the one who would be taking care of the real estate powers should be limited. Because what happens is if the powers are unlimited or they're also the beneficiary, not subject to some ascertainment standards, then what would happen is it would not be a part of estate protection for the trustee.
So maybe I'll just add one comment there on there for clarity, like if you use a trust, it can work, but you gotta make sure that you don't inadvertently have terms that make you the owner again, and then it's subject to so you've undermined the benefit. So you have to use stuff like ascertainable standard and the terms of how the trust really matter. And who's trustees, beneficiaries, all that stuff, it has to be carefully crafted. I've seen that used quite a bit of by a lot of clients, but it's the crafting matters and how it's executed also matters.
Right. So the next trust, which we will just touch base with this trust, just so that you understand, there are a lot of trusts that can come in picture. The very common structure which we have been using in the US, especially for the Canadians, is irrevocable trust. It is the setup cost is there. There are a lot of rules. You need to make sure you follow all the regulations, all the line by line item to make sure it doesn't fall in your estate. The most important thing is that you have to lose the control of that property, of the real estate. If you still have a control of that property, then like no matter what it is, it would still be considered as a part of your estate. If you have put in the money in a trust, created a trust, put in the money, and the trust buys the real estate, great, but you cannot be a beneficiary and you cannot have the control of that. The trustee has to manage that property. You have a right because till the time your spouse is alive, you can use it rent-free. But later, we need to keep in mind that it is, if you have a control, then it's part of your estate.
So, Priya, given that we only have a few minutes, maybe just get to the, like, if somebody's interested in the irrevocable trust, we can talk about it and they can contact us after.
Correct.
I think we should have a few minutes just to summarize and.
Correct. So, do we have any questions?
Not right now, unless someone wants to unmute themselves, or you can maybe summarize and then we can, you guys can think if there's any questions and we can go right there at the end.
Sure. To summarize our overall presentation, I would say that Canadian residents are subject to US tax in another country based on the location of their property or based on the citizenship. Very simple example is our US citizens living in Canada. So treaty reliefs are available, but we need to keep that in mind. Canadians are entitled to reduce their US estate tax by claiming the benefits under Canada-US tax treaty. But remember, you can only claim the treaty benefits if you are filing the return on time and making the payment on time. If the return is not filed on time, as I mentioned before, the treaty benefits are denied. And even the foreign tax credit, which Jason also talked before, would not be accepted by the Canadian government or by CRA because you did not file the return on time, or you couldn't get the exemption, which you would have gotten the exemption if you did the filings with IRS as per the regulations. So, and mentioned the returns are due 9 months after the date of death. Executors are responsible to do the timely filing or timely election or timely extension or make the timely payments. Again, US tax rules are very complex. We certainly recommend considering a cross-border tax plan if you believe your estate is caught under US estate tax rules.
And that also may change the people in a year.
Right, that may change. Yes, exactly. And this presentation is a very general presentation we're doing. It's not very specific to one situation. We kind of have covered a lot of topics. And portion of it may be applicable to you, but not 100%. So keeping in mind, it's a general information. If you have any questions about the points which we raised, or if something is related to you, please contact us and then we can guide you through, but it is just an informational presentation, no advisory.
Well, I think the issue is you need to, I think you need to evaluate your own situation, and based on, if we evaluate the situation, it might be a different plan for everybody. But again, you go with simple first, and then if it needs to be complex, we'll work on that, but most people don't like to talk about estate taxes, but we want to make sure that you don't inadvertently step in a puddle.
Okay, so thank you very much to you both. We do have one question or comment from the audience. There was no content about how to navigate cross-border tax issues in a day-to-day business concern, such as e-commerce. Is that something you would be able to touch upon if I connect you both?
Sure.
We could, it wasn't relevant to the estate tax part of it, but there's lots of US issues to deal with, and I thought this was probably one of the most common ones that would affect people. That's why we started with this.
Thank you again,
Thank you very
everyone.
much.
Have a great day. Enjoy the day. Take care.
Thank you.
Thank you.